So very good morning everyone. Today in this lecture we are going to continue with what is not regarded as a transfer, which is profoundly called as exempted transfers under section number 47, read with section number 45. So in the last class we have already completed partition of HUF and transfer of capital assets thereon, tax implications, logical understanding, reason behind the provision. Each and every minute of the details we have already analyzed in the last class. Okay. So today in this lecture, so we are going to continue with section 47, clause 3. Previous class 47, clause 1. Where is clause 2? Clause 2 is omitted now. So clause 2 is no more in existence. Clause 2 is irrelevant. It is omitted, deleted. So clause 3 we have to read now. As I already said in the last class, clause 3 is an amendment applicable for May 26 CA final and CA inter exams. Okay. For everyone, this is an amendment. 47 clause 3. A very good amendment have come. Reason for amendment, logic, everything we are going to understand in the today's session. This particular session will be very complicated session because we are going to read section number 47 class 3 along with section 45 subsection number 1, read along with section number 49 subsection 1, read along with section 49 subsection 4, read with section 56 subsection 2 class 10 subclass A item A and item B, section 56 subsection 2 class 10 subclass B item A and item B, section 56 subsection 2 class 10 subclass C item A and item B. We are going to read in conjunction with all these concepts together to make this concept 100% complete. And to all the students, I am again repeating, I am going to cover the most important aspect of other sources chapter here itself, which means income from other sources concept. There is a concept of cash gift, immovable property gift, movable property gift. These three things are very important there in other sources. I am going to cover them here itself. So again, don't ask me to reteach the same concept of other sources again. Clear? When we come to another concept in the capital gains chapter itself. So in the capital gains chapter itself, we will be coming into a section called as section 46, which will be called as distribution of capital assets at the time of liquidation. 46. Along with liquidation here, section 2 clause 22 reduction of share capital, liquidation of company 222B, 222C we will cover here itself. Next, 46A section capital gains chapter, amendment applicable for Jan 2025 exam itself. Jan 2026 exam itself. It's an amendment applicable for that exam. That amendment, along with the section 2 clause 22 subclass F, new provision for deemed dividend in buyback, okay, which was provided in other sources, I'm going to cover here itself. To sum up everything, I'm making it simple. Listen carefully. Other sources chapter, 30% of other sources which is not covered elsewhere, we will cover in other sources. 1 hour to 1.5 hours. Remaining all other sources aspects, we will be covering and completing in capital gains itself. So don't again force me to reteach the concept because of your inefficiency to listen to this concept. Clear? So I'm very clear again. Heads of income, all heads of income applicable for final I am going to cover. PGBP, depth, not normal. 50-60 hours we will spend on that because I am going to cover PGBP along with MAT provisions, along with the concept of what is this PGBP, along with the other kinds of entities like a trust assessment. All these things we will cover in a flow. So listen again. PGBP along with MAT, along with ICDS, I will be covering in PGBP directly for CA final. So at that time I will cover ICDS there itself. Okay, ICDS anyway not there in inter level. Final level ICDS is applicable. So income computation and disclosure standards I will merge with PGBP and I will complete. MAT provisions I will complete. AMT I will complete. Firm assessment I will complete along with PGBP. So don't again force me, sir, assessment of firm, separate chapter in study material where we will discuss, but not in the sequence of institute, but in the logical sequence of the lawmaker. Assessment of firm should be read along with section number 40 class B in PGBP. There itself I will complete. Firm means all concepts relating to the firm will come in one slot. Okay. PGBP means PGBP with section 10AA with profit linked deductions and investment linked deduction under 80 IA. All the series of sections will complete. Then we will start doing MAT provisions. Other one big slot again. So my sequence is, this is not to exaggerate, my sequence will be the best sequence in learning DT because we are going by bare act. Wherever in the section reference to a section comes, we will cover all the reference section there itself. Then you will have more clarity in thought process. Hopefully you are clear, right? What is the conclusion now? In the chapter of capital gains itself, 70% of the other sources chapter we are going to cover. Okay. So if any inter students are listening to the same lecture now, for you other sources I covered separately. This will be bonus for you. Double impact. Okay. For inter level, this much of interlinkages and other things are required, but not that much required. But you can really enjoy after listening to capital gains interlinkage with other sources. Okay. But final students, for you, these are exclusively meant to be. So therefore, learn in a proper way. Clear? Let's begin. See, in the last class, we completed transfer of capital assets at the time of partition of a HUF. Okay, at the time of partition of a HUF. When HUF is going on a partition, at that time, if there is any transfer of capital assets, what will happen? We have seen. Now we are going to see gift given. If the gifts are given, how to tackle the situation is a question now. Okay, what is given? Gifts are given. Gifts are of three types. Number one, cash gift. Number two, immovable property gift. Number three, movable property gift. Okay, repeat again. Cash gift and a sum of money, immovable property gift, movable property gift. When I say movable property, in that specified movable properties only will come. What will come? Specified movable properties. Sir, what is a specified movable property? We will discuss. At that time, I will tell you. Now you need not worry about what is a specified movable property. I will tell you. I will show you. Bare act provision, I will show you directly. So then you can also understand, okay, these are all specified movable properties. That is one target for the today. Next, understanding interlinkage of various sections. How? Let's directly dive into the position now. What is the law position on these? Let's see. See here. Section number 47(3). Amendment with effect from 1/4/2025. For the May 2026 students, amendment is applicable. Sir, I am writing for Jan 26, sir. Then what is my position? Then prior amendment you should learn. Writing for May, post amendment you should learn. I will teach both such that those who are writing for Jan, you will understand what is the position present. For those who are going for May, you will understand what is their prior and why lawmaker brought amendment and what is the amendment. Everything you will understand. Okay, let's begin. 47(3), class 3, because clause 2 is a deleted content. 47 clause 2 is a deleted content. 47(3). Okay, so 47(3). You can see here na bare act. See reference 43 point they have given na 43 referral. One 4/2025 onwards, with effect from that it will come. Okay, from 1/4/2025 with effect from 1/4/2025, this amendment is working out. So be careful. New amendment. Okay. Nothing contained in section 45. I will directly show you the bare act in my book. See, what is required for our understanding, I kept separately. Let's see. Nothing contained in section 45 shall apply to the following transfers. Any transfer of a capital asset by an individual or HUF under a gift or will or an irrevocable trust These are three things that they have given. Okay, read properly first. First, read it. Don't read amendment content. That's a problem with you. You will read unnecessary content and leave the main content. Read the Bayrak directly here. Whenever you are reading clauses, you should not read clause directly. First, read the main provision. Then read this in continuity. Okay. Sir, I have given you around 1.5 minute time. Time is always given. Listen, those who are listening to the class now over YouTube or through the app, wherever if you are listening to this, whenever I give time by showing the Bayrak on the screen, first point you should understand, I am not a damn bloody fool to just give time. You should not skip and go to the next content. When I am giving the time you are listening to the lecture. Go with the flow. I give 2 minutes, sometimes for 5 minutes time also I will give to read a provision. Why? That particular provision deserve that particular time to read and understand. When I give time for you to read, respect not me, respect the subject you are reading. Okay, why I am telling now, I know about students what they do. Whenever open screen is there, taka forward, they go to the next one. You are cheating yourself here. Seriously, take my words with a pinch of salt. Seriously, I'm telling that. You are cheating yourself. I gave you time. Okay, what I will do in that 1.5 minute time, I have books with me. I will refer to that. Okay, so I will try to bring more content into that. Okay, you should not just skip the content and go to the next one. When I give time, at that time, your mind should start working. What is the provision? What is there here? What I am going to tell? Your mind should work on that. 1.5 hour, 2 hours lecture means that 1.5 hour get involved into direct access. This subject is not just like something superficially learn, later we can do. It will not work that way. So you have to spend time, you have to understand the contents clearly. Clear, everyone? Respect the subject you are reading. Let us now read together one last time. Nothing contained in section 45 shall apply to the following transfers. Means what? As I already said in the last class, these are all transfers. Okay? So don't call, this is not a transfer. This is a transfer. But this transfer do not trigger section 45. What is 45? Chargeability of capital gains tax. So these transfers, in this also transfer will be involved. But these kind of transfers do not trigger, section number 45. Section number 45. For your understanding, shall I tell you an easy way to remember this concept? See, this is section 2. Section 2, clause 47. Section 2, clause 40, not section 47. Section 2, coincidentally, transfer is section 2, clause 47. what do not attract 45, what transfers do not attract 45 is section 47. So don't get confused. It is 2 class 47, that is section 47. Coincidentally, both are 47s. Okay. Sorry. Anyway, let us understand what is this AK-47 rule. See, if the list whatever we are reading now, 47, 1, 3, all these, if they are not transfers, in the definition they should be excluded. If they are not transfer, in definition they should be excluded. In what? In definition they should exclude. Okay. But try to understand clearly, there transfer is involved, but the transfer do not trigger 45 section. Understood? See, I will explain this way. See here. Transfer in relation to capital assets includes, not these. These are only some examples. Okay. See, HUF is partitioning its assets and distributing it to the family members is nothing but relinquishment of assets by the HUF and transferring into the hands of members of HUF. Actually, HUF partition time, like the capital assets are distributed, that comes under relinquishment of assets by HUF. It is a transfer, but that transfer do not trigger section 45. That is the way in which you need to understand. Hopefully everyone got a clarity now. Yeah. So now try to understand. Nothing contained in section 45 shall apply to the following transfers. These are all transfers, say, but these transfers do not trigger 45 section. So capital gain tax will not be there, though there is a transfer of this kind. Let us continue. There is a transfer of what? Of a capital asset. By whom? By an individual or HUF. What is the mode of transfer? 3 modes they have given. One, gift. Second one, will. Third one is the irrevocable trust. Third one is the irrevocable trust. So let us understand the concept now. So transfer is made of a capital asset by an individual or HUF under gift, will or irrevocable trust. Okay. Gift, will or irrevocable trust. Sir, then where is inheritance, sir? Inheritance is submerged into this will. Will be given by a person and transfer happens upon the death of that person. Generally, it's like there is a person, he is in deathbed, he is writing a will saying that upon my death my properties will go into his hands. There is no consideration involved here. What is not involved? Consideration is not involved. If you observe gift, will, irrevocable trust, a common thing is transfer do not involve a consideration. Transfer do not involve consideration. Gift consideration is 0. Gift is out of a natural love and affection. Where is a concept of consideration coming into it? So, any transfer made as a gift or will or irrevocable trust by an individual or HUF is not a transfer attracting section 45. That's the way in which you need to understand. But this provision is not so simple like what we read. There are a lot of things that we need to discuss along with this. Let us go into connected provisions now. See, so now question number 1. Sir, what is the position prior amendment? What is the position post the amendment? Prior amendment provision is like this. Any transfer of a capital asset, by any person, by an individual or HUF. Previously, any person giving to any person. In that any person, who will also come? Companies also will come. Therefore, companies are using this section as, using this section as a wrong way to convert their black money into white money by giving a gift and escaping the capital gain tax. Therefore, lawmaker thought this way. We should not give the benefit of this particular 47(3) to the companies, because for Koushik Mukhesh or for you, giving gift is a natural thing. We will give gifts on marriage days. We will give gift on marriage occasion. We will give gift on birthdays. We will give gift to relatives out of natural love and affection, irrespective of an occasion. Some achievement can happen, we will give. But companies are not having a natural love and affection. From their government of India got one doubt. Why companies will give gift? Correct? Why companies will give gift? Yeah. What is a gift? Gift is something given out of a natural love and affection. Companies will have natural love and affection. Then why gift has to be given? The first funniest part is amendment came recently applicable for May 26. Now I am getting a doubt. This provision I know from very long provision. But at that time also, when I used to teach other sources, I used to tell any person represents companies also. But why company will have any natural love and affection towards anyone? Company is an artificial person. That's what government of India got an idea in the year 2025. They got idea. Why companies will have natural love and affection? Why companies will give will? Why companies will give a irrevocable trust? Irrevocable trust, okay. But gift and will, why companies will give? Therefore, they excluded companies from this. That's the main reason for this amendment. So, rationale of the amendment. Prior to the amendment, companies used to argue that gift by them will not attract CG tax. To plug this lacuna means loopholes. Finance Act 2025 made an amendment removing companies and including only individuals and HUF. Fair enough to understand the concept. Okay, done. So what is the amendment? Prior to the amendment, any person giving gift to any other person, okay, he is attracted by this. Simply to tell, whenever there is a gift, there are two people, donor, donee. Donee, DONEE, not DHONA. I'm the Dhoni illa. I'm talking about donee. So, donor whenever is a company, donee whenever is any person, that is also not a transfer attracting capital gain once upon a time. But Finance Act 2025 made an amendment bringing only individuals and HUF within the purview of the exemption, and companies are away from the exemption. Therefore, if a question comes in exam, companies gifting, it is now taxable capital gain. Okay. Next. Basic provision. Let us reread the concept. There is a transfer of capital asset made by individual or HUF to any person. When I say one 425 to any person, transfer is made as a gift or will or irrevocable trust. It will not be treated as a transfer under section 47. Okay, because of that 45 shall not apply. 45 shall not apply means 48 also will not apply. Okay, next, interconnected provisions is a golden discussion we are going to make. If there is any qualitative discussion which adds some understanding to you, that is this one. 47.3 is easy, but 47.3 read with section 49.1, read with section 49.4, read with section 56 subsection to class 10, subclass A, subclass B, subclass C is the gifted discussion we are going to do today. Interconnected provision. Okay. Now I will give time for you. How many minutes? 2 to 3 minutes time I will give you. Your work is very simple. Read 49.1, subclass number 2 and 49.4. Do your work properly. Okay, clear? Now, see, what is the subject matter of discussion of section 49(1) and 4? What is 49(1) discussion and what is 49(4) discussion? What really they wanted to convey? Huh? What is the discussion here? Why we are reading both together, 49(1) and 49(4) now? Question will arise now. Listen carefully. And why we are reading section 56? Reference is given here. Of course, 7 and 7A has no relevance now. This act was made long back. Now, at that time, 7 and 7A used to have a relevance. Now, 7 and 7A has no relevance today. Those sections gone. Okay. So, 10 has a relevance. The 10 we are going to discuss now. Okay. Let us start. Let us understand the subject matter, what they wanted to convey. See here. There is a person. I call him X. Y, Z. X gave gift to Y. Capital asset gift. When I say gift, consideration not there. Okay. Now what will happen? X is an individual, Y is an individual. Therefore, individual giving gift to another individual will not attract capital gain tax, and eventually consideration is missing. Then automatically what will not be there? There is no question of capital gain because section 47 class 3 will get triggered. Because of that, section 45(1) will not attract. Because of this, section 48 will not get attract. Sir, what do you mean by 48 do not get attract? Listen, 48 is a computation schedule. Computation schedule of what we have seen? Full value consideration minus expenses of transfer, net consideration minus cost of acquisition minus cost of improvement, capital gains. It is schedule provided in which one? Section 48. Now, expenses on transfer, maybe certain things can be there. Gift na stamp paper, some small expenses can be involved. Maybe chance is there. And net consideration you have to write. Cost of acquisition. X might have purchased the asset. That only is gifted or not. So for him there will be a cost of acquisition or not. That cost of acquisition we will write here. Improvement generally won't be there. Capital gain we have to write. But the problem is the first one is a missing figure here. What is the missing figure? This capital asset is transferred as a gift. Gift when you transfer, consideration is missing here. What is missing? Consideration is missing. Therefore, what will happen? Consideration is missing means the first figure in the computation table is not known at all. Not known. It can't be written. Okay, because the consideration is missing in this case. Therefore, because of that reason, what lawmaker said, since the first element of computation itself is missing, computation of capital gain is not possible. Therefore, they said this do not trigger section 45. Okay. Now, doubt will come to students. What is the doubt? Sir, no, sir. Interlevel I heard somewhere. Whenever the consideration we can't calculate, fair market value of that asset can be taken. If it is a movable property, if it is immovable property, stamp duty value will be taken as notional value. Like that we need to do. You are wrong. Shall I tell you why you are wrong? Listen. When asset is transferred from one person to another person, okay, for some value, when it is transferred, but that value is unknown. In that case, a fair market value, stamp duty value will come into picture. Here, consideration is not unknown. consideration element itself is not there. Therefore, since consideration is a missing element, full value consideration is taken but not at appropriate value. So consideration is not there. Therefore, what lawmaker said, in this case, capital gains will not get attracted because of a reason that consideration is a missing element here. One concept over. Up to here already we discussed. Any transfer of capital asset made by an individual or HUF to any other person, either by way of gift will or irrevocable trust, will not be treated as a transfer attracting 45. Understood. Now the question starts. This Y is there, na? This Y sold this asset to Z for a consideration, let us say 1 lakh. For a consideration of 1 lakh. Sale, not gifted. Again, gifted on Y side also, no, there is no capital gain. Any number of times gift do not have capital gain. Yeah, simple logic. So Y sold this to Z. Consideration is how much? 1 lakh is a consideration. Now you should answer me, I should listen. Y sold to Z means there is a transfer. Yes, because transfer definition, a transfer includes sale, exchange, relinquishment of any asset. In that sale is involved, so there is a sale of capital asset for a consideration. How much? 1 lakh. Now there is a capital gain or not? Yes, there is a capital gain. Now two questions I have. In the hands of Y, there is capital gain. There is capital gain. Full value consideration is how much? Question 1. Because the value whatever we sold, 1 lakh, okay, minus, let us say expenses on transfer, all this nonsense is not there, improvement also not there. Cost of acquisition, how much? Y acquired from X by way of a gift. By way of a gift. Who? Y acquired this particular property from X by way of a gift. So gift he got, means there is no consideration. Then you don't acquire anything by paying any cost. So cost is a missing element here. How much will be taken as that cost? Question 1. Sorry. Now I got what? Capital gain. Some amount of capital gain came. Okay. Now capital gain came. Whether this is a long term or short term depends on what? Depends on the holding period. Depends on holding period. X purchased this on 1/4/22, transferred on 1/4/25. Y sold to Z on 1/6/25. If you observe, Y hold that property on 1/4/25, sold it to Z on 1/6/25. It is less than 12 months. Less than 12 months. Okay. Next question. If you consider from 1/4/22, it is more than 12 months, it may become a long term. If you take this holding period, it will be a short term. What should be taken? This is the second question. Therefore, to answer both these questions, okay, to tell whether it is long term or short term, we need to read section 2 class 42A. Okay, to know about this, we need to read section 49(1). What is cost of acquisition? 49(1) will tell. What is the holding period? Whether to include only my holding or whether to include the holding period also of the previous owner will be dealt by section 2 class of 42A, explanation number 1. In that sub explanation number 1, in that class B, you have to read all these to understand correct meaning behind this transaction. Okay, so sum up everything. X transferred, where any individual or HUF transferred any kind of capital asset by way of a gift to any other person without a consideration, there will not be a capital gain because it is an exempted transfer under section number 47(3). But subsequently, if that asset is transferred by the donee to some other person by way of a sale, relinquishment or exchange, etc., then they squarely attract the concept of capital gain because the transfer of a capital asset other than by way of a gift or will or irrevocable trust is getting attracted. Section number 49(1) will get attracted. What it said, you should read and tell me. Okay. So what they said, where the capital asset became the property of the assessee. Here he is talking about why in our example, where capital asset, gifted capital asset, became the property of the assessee. Assessee means whom? Why? Under gift or will, the cost of acquisition of the asset shall be deemed to be the cost for which the previous owner of the property acquired it. Who is the previous owner? X. His cost of acquisition you have to consider. So consider the cost of acquisition of the previous owner of the previous owner. Who is the previous owner? X. What is his cost of acquisition? Let us say he purchased it for 20,000. That 20,000 you have to do, and the balance will be 80,000 that will be subjected to capital gain tax. Now, going back to section 2 clause 42. In case the capital asset which becomes property of the assessee in circumstances mentioned in 49(1). 49(1) one of the point is gift, will or inheritance, irrevocable trust. There shall be included the period for which the asset was held by previous owner referred to in that section. So it should include the holding period of the previous owner also. So previous owner holding period also should be included into it. So therefore, it will automatically in our example will become long-term capital gain, but not short-term. Hopefully everyone understood the logic up to here. Next. Then what is this subsection number 4 of section 49? Where the capital gain arises from the transfer of a property, the value of which has been subject to income tax under clause 77A. 77A irrelevant now. 10 is relevant. Clause 10 of subsection 2 of section 56. The cost of acquisition of such property shall be deemed to be the value which has been taken into account for the said purposes of said clause 77A and 10. Sir, I did not understand. Again read. Your work is to read. My work is to explain the intention behind the lawmaker. Okay. See here. So what you have to understand, where the capital gains arises from the transfer of a property, the value of which has been subject to income tax under clause 7, 7A and 10 of or 10 of subsection 2 of section 56, the cost of acquisition of such property shall be deemed to be the value which has been taken into account for the purposes of the said clause 7, 7A or clause 10. 7, 7A irrelevant, 10 is 100% relevant. Okay. So what is subsection number 2, class 10 of section number 56? Let us first try to understand. This is the text of the Bail Act. Sir, very big, sir. It will be big only. That's why it is more complicated. So the complication, if you reduce, then only you will be great. Na? Complication is there, I will leave the section means when you will become great. I read properly. Start. Section 56, subsection 2, clause 10. What it says? where any person receives in any previous year from any person or persons on or after the first day of April 2017. So anyway, we are in 2025. After first day of April 2017, pakka. Next, any sum of money without a consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum. Any immovable property without consideration, the stamp duty value of which exceeds 50,000 rupees, the stamp duty value of such property. Next, for a consideration, the stamp duty value of such property as exceeds such consideration if the amount of such excess is more than the higher of the following amounts, namely amount of 50,000 rupees and the amount equal to 10% of the consideration. Provisos you leave. We are not going to discuss now. See, any property other than immovable property without a consideration, the aggregate fair market value of which exceeds 50,000 rupees, the whole of the aggregate fair market value of such property. For a consideration which is less than aggregate fair market value of the property by an amount exceeding 50,000 rupees, the aggregate fair market value of such property as exceeds such consideration, provided that this clause shall not apply to any sum of money or a property received from the relative or occasion of marriage of individual or under any will or by way of inheritance, etc. Dotted line I have given. So many are there. Examples, 3 things I have given. Time will be given to you. I want you to read 10. Do one thing. I want you to read 10 A, B, AB here, 1, 2 here. Leave the provisos now and read C, AB. That is your work. Provisos don't read now. I will explain separately what is the proviso discussion. Here only, we are not going to postpone any single line here. As whatever is there on this page, okay, except 43 CA, except 43 CA, we are going to discuss all the provisos also here itself. Sir, 43 CA, why you are not discussing, sir? 43 CA is a PGBP section. When we come to PGBP, we will discuss about 43 CA. This is not the time. Okay. So now it's your time. Read the Bare Act. 56, subsection 2, class 10, subclass A, item A, item B, of subclass B, item A, item B, of subclass C. Start. Read properly. Very, very complicated interconnection, harmonious construction we read now. That's what we are going to apply now. Okay, enough time taken. So let's continue. So let us continue. See here. Where any person receives in any previous year from any person or persons any sum of money without a consideration, the aggregate value of which exceeds 50,000 rupees, the whole of aggregate value of such sum, immovable property without consideration, the stamp duty value of which exceeds 50,000 rupees, the stamp duty value of such property. For a consideration, the stamp duty value of which of such property as exceeds such consideration if the amount of such excess is more than higher of the following amounts, namely amount of 50,000 rupees and not or amount equal to 10% of the consideration. Amount equal to 10% of the consideration. These are the things they have given here. Okay, let us now try to understand the concept clearly. See here, section 56 subsection 2 clause 10. I will explain you the logic first, after that let us read. See, sir, this will take time, but once you understood na, again in your life you need not again come back and read. New Income Tax Act came na, Income Tax Act 2025. There also I read the ditto, they copied and pasted. Section numbers are changing. So listen carefully once. Again you will not get any doubt. Okay, listen. A, B, C. A has given gift to B. A gave gift of capital asset to B. B sold this capital asset to C. There is no consideration between A and B. There is a consideration between B and C. Okay, this is point number 1. Okay, now question will arise. Between A and B there is a consideration. There is no consideration. Therefore, transfer under section 47(3) will be exempted and 45 section won't get applied. 48 also will not get attracted up to their doubt illa clear. Okay, 47(3) will get attracted. 45 not attracted. 48 not attracted. Up to here, clarity of thought process, everything is clear. Okay, now the question arises. Capital gain do not get attracted in the hands of A. Okay, but gift tax will get attracted in the hands of B or not? Hey, listen, yeah. A gifted to B. In the hands of A, there is no capital gains. 1000% clear. But recipient hands, like gift tax will get attracted. Na? Gifts are given. So obviously tax will get attracted. Listen carefully now. B has taken it as a gift. Correct? Now question arises. Who is A to B? Relation, you tell. Two situations. A is a relative. A is not a relative. First one, A is a relative. Next one, A is not a relative. If A is a relative, gift from a relative is not taxable in the hands of B also. Means what? For example, under section number 56 subsection to clause 10, if the gift is received by a person from any other person being a relatives between each other, there is a relative definition. Na? Under that, for example, father gave to son. Obviously, it's a relative definition they are coming. Na? So therefore, what will happen? A is a father, B is a son. A given to B. For A, there is no capital gains because it is gifted to some other person. It's a gift. Irrespective of whether relative or not, gift is not taxable. But in the hands of B, it is taxable. In the hands of B also, it is not getting taxed. Why it is not getting taxed? Gift from a relative is exempt under 56. Hey, mind, apply here. Nothing in this clause shall not apply or shall not apply. So provided this clause shall not apply to any sum of money or property received from any relative. So if the receipt is A and B are relatives, then B is not even subjected to tax under IFOS head. So CG head la A is not paying tax, IFOS head la B is also not paying the tax. Now none of them are paying the tax in this gift transaction. Government is losing a lot of revenue. Therefore, what government said, if subsequently, I repeat, if subsequently B sell the property, if subsequently B sell the property in the hands of B, capital gains will get attracted, cost will be the cost to previous owner, consideration will be the consideration between B and C. Long term, short term will be dependent on the period of holding of the previous owner. Up to here, clear? Now, reverse the case. A, B, C. A gave gift of capital asset without a consideration to B. Section 47, 3 attract. Section 45, do not attract. Section 48, do not attract. Capital gains will not attract. Up to here, clarity. Now, who is A and B? A and B are non-relatives to each other, friends. Friend is not a relative, na? You can't bring them into relative definition. So it's a non-resident. It's a very sorry. It's a non-relative. Non-resident. It's a non-relative. So A and B are not relatives. They are non-relatives. Okay. Now tell me what will happen. For example, this capital asset is a movable property. Okay. This capital asset is a movable property. What is the value? Let us say 1 lakh is the value. But I did not take anything. I gifted. Say for example, shares are given. By whom? A gifted capital asset being shares of a particular company to Mr. B without a consideration, but the fair market value of those shares on the date of giving the gift is 1 lakh rupees gifted to B. B is a non-relative. Therefore, in the hands of B, fair market value will become taxable under the head IFOS. Yes, he paid tax. Who paid tax? B paid the tax at the value of FMV since the movable property. See here. See. Any property other than immovable property means what? Specified movable properties without a consideration, aggregate FMV of which exceeds 50,000. The whole of that aggregate fair market value of such property is taxable under the head IFOS. Now tell me, what is a FMV? 1 lakh. 50,000 more than 50, more than 50. Then entire 1 lakh will become taxable in the hands of B under the head IFOS, not under the head capital gains. Though A is not getting taxed, B is subjected to tax now. B is subjected to tax. Story doesn't end here. Done. Now the question. B paid tax under IFOS. Yes. FMV how much taken? 1 lakh. Now after 4 months, 1/4/22, 1/4/25, 1/8/25. Okay, April, May, June, July he held. August 1st he sold for 1,50,000 rupees. 1,50,000 rupees. To whom? C. Now listen carefully to the point. So now what will happen? Full value consideration 1.5 lakh minus cost of acquisition of this particular asset. Cost of acquisition will be cost of acquisition to the previous owner. Because 49 and 1 will get attracted. So since 49 and 1 will get attracted, cost of acquisition to the previous owner. Previous owner acquired it for 20,000. So 20,000 we have to take. Like this, you should not think. The reason is 49/4, that's why it came. Previous example, acquisition is made as a gift or will without attracting 56, but which has been subjected to income tax under 56(2)(10), then cost of acquisition of such property shall be deemed to be the previous owner cost. Illa, shall be deemed to be value which has been taken into account under clause 10. FMV has to be taken. The beauty of this particular provision. Understood the point clearly? So you should not take cost of acquisition by the previous owner because already I paid tax now. So that value only you should consider. So my cost of acquisition should be the value which I considered for the purposes of IFOS when I am paying the gift tax. At the time, how much amount I have taken? FMV. That should be taken as my cost of acquisition. So you should consider 1 lakh and 50,000 is only subjected, not 1,30,000. So 49(1) mode, 49(4) mode, you should have in mind. 49(4) will get attracted if the recipient, the donee, has already paid tax under IFOS head. Then the value, the cost of acquisition shall not be deemed to be the cost to the previous owner. It shall be deemed to be the value which is considered for the purposes of the head IFOS for the assessment under section number 56, whatever the value has taken, that value you have to consider. Everyone understood? If you really understand, if you are listening on YouTube, comment. If you are listening on the app, put a message to me whether you are really understanding this concept or not. So my point is very simple here. Try to understand. If a recipient is subjected to tax, then 49(1) will not get attracted, 49(4) will get attracted. If the recipient is a relative or any other reason which do not attract IFOS by way of exemptions to IFOS, then cost of acquisition will be the cost of acquisition to the previous owner. Okay, and then accordingly 49(1) will get attracted. That's why 49(4) came into Income Tax Act. Is the reason for bringing section 49(4). The rationale behind 49(4). Okay. Now, section 56, subsection 2, class 10. In this, there are 3 kinds. One example I told you, na, movable property, immovable, other than immovable property, and a specified movable property. Now we are going to discuss about point A and point B and point C also one more time, such that you will have a full clarity. Okay. First, listen. Third example, A, B, C. A acquired property on 1/4/22 for 1 lakh. Gifted this capital asset. Gifted capital asset without a consideration. 47, 3 get attracted. 45 will not get attracted. 48 will not get attracted. Capital gain will not get attracted. I mean, tax on capital gain will not get attracted. Next. B. Whether it will be taxable to him or not taxable situations. Specified situations under section 56, like relative, occasion of marriage, death contemplation, etc. These situations are okay, yes, or other cases. Okay. Now, see here, specified situation under section 56. And if B is a relative or B received it on occasion of marriage, where it is exempted under 56. Okay, those kinds. In this case, section 49(1) will get attracted. Cost of acquisition will be cost of acquisition to the previous owner. So second branch I will fill. I have some point to discuss, then I will fill this. In all other cases, section 49(4) will get attracted. Cost of acquisition will be the value that is considered under section 56. Subsection 2, obviously, I am not writing fully. Section 56 to 10, whatever value you considered at the time of assessment of your income under the head IFOS, that value will be considered to be cost of acquisition. Cost of acquisition. Okay, listen carefully. Now, my question. B sold capital asset for 2 lakh. To whom? To Mr. C. To Mr. C. Okay. Now listen carefully. Now listen carefully. For example, let us take this situation. Okay, this situation. Full value consideration will be B sold to C na 2 lakh. Cost of acquisition, you did not acquire na, it's a gift. Therefore, and it is moreover not even assessed under section number 56 because it is received from a relative. Okay. So since it is from a specified occasion, relative, occasional marriage, etc., it will not attract IFOS head for him. So cost of acquisition will be as per section number 49(1). Okay. Anyway, I have said here. So cost of acquisition will be cost of acquisition to previous owner. Capital gain will be 1 lakh. Okay, whether this is short term or long term, how I will take? I will take on the basis of period of holding to the previous owner under section 2 class 42A explanation 1 sub explanation 1 point B. Okay, so previous owner holding period also should be included. I took on 1/4/25, sold on 1/6/25. Okay, you should not consider period of holding as, okay, see here. Here 3 years, here 2 months. You should consider A, B, C, B to C you should consider, or A to C you should consider. A to C you should consider, not just B to C. So 3 years and 2 months, which will be treated as long-term capital gain. This 1 lakh is a long-term capital gain. This is the first concept that you need to understand. Okay. Now listen to the second category. Let us say B is others, means it's not a relative, friends. 49(1) will not get attracted because 49(4) clearly said if the transaction of transfer attracts capital IFOS head under section 56(2)(10), then the cost of acquisition should not be taken as a previous owner's cost. It should be considered as the value which you have considered for the purposes of IFOS. Movable property IFOS na fair market value. Immovable property ke stamp duty value. That value you should consider. Obviously, we need to consider FMV. Let us say FMV is 1.5 lakh. FMV is 1.5 lakhs. So what will happen for this 1.5 lakh? IFOS headlight will be taxable. Which head? IFOS. Because it is exceeding 50,000, IFOS the full amount ki tax blast. So full amount of 1.5 lakhs ki there will be a levy of tax. This is assessed under the head IFOS. That value you have to consider. So full value consideration 2 lakh minus cost of acquisition. Already you paid tax of 1.5 crore, 1.5 lakhs ki you have paid tax na. Again considering the value to that person means extra 50,000 you have to pay tax. Therefore lawmaker don't want to harass you. So already you paid na, that amount you reduce. Balance capital gain 0.5 lakh. Previously 1 lakh. Now it is only 0.5 lakhs you are going to pay the tax. Up to here understood? Okay. So capital gain paid. Now whether this is short term or long term, which one this is? Period of holding. Period of holding. Period of holding will be as per section 2, clause 42, explanation 1, sub explanation 1, class B. Wrong. This is the next twist we need to learn. Let's go back. See here. In the case of a capital asset, which becomes the property of the assessee in circumstances mentioned in subsection 1 of section 49. Subsection 1 of section 49 means a 49 one mode. 49 one mode means what? 49 one mode means it should not attract IFOS also. Then only it will get attracted. Previous owner holding period. Anyway, if it is a 49-4 mode, I paid tax in IFOS, na? You should consider only my holding period. So therefore, the period of holding will be period of holding by the assessee only. Okay, period of holding. Previous owner term should not be included. This is another twist. Here it will become short-term capital gain of 0.5 lakhs. Understood the point? Like this, interconnections, if you read, then you will understand. I hope that everyone understood the logic clearly. Next. So, the next part of discussion. I completed discussion of 49.1.2 point and 49.4. 56 subsection to class 10. Logic and understanding we did, but in depth we did not go. Now we are going into it. Okay, sorry. Now I have one question. See the screen. See the screen. If you see section 56 subsection to class 10, he used the words like this. Immovable property. Any property. He did not use the word capital asset. He used the word property. Capital asset can be capital asset. Okay. The property can be of two types. Property being capital asset, property not being a capital asset. What do you mean by that? Capital assets can be of, properties can be of two types. Property in the nature of capital asset, property not in the nature of capital asset. Car is a property, use it for my personal purposes. It is a personal effect, not a capital asset, but it is a property. So all properties are not capital assets, but all capital assets are properties. So property include capital assets and non-capital assets also. Here they use the word any property, immovable property. They did not use the word immovable property being a capital asset. But in all my examples, I have treated as if they are all capital assets. Then how come it will justify our discussion now? Hey, understood or not? See, again I am telling. Section 56 subsection to class 10, if you read, they use the word property. Property can be of two types. Property being a capital asset, property not being a capital asset. Now, in all my examples, I discussed in such a way, all properties are capital assets. But here they use the word property, that's all. Loosely held word. Property includes capital and non-capital assets as well. Then, that we did not discuss now. The next discussion is on that. So, how to read section 56 in the context of capital gains is the next point. And do you know what I can ask you now? For example, A transferred to B his color TV, used it for his personal purposes. Who? A used it for personal purposes, purchased the TV, used it for 2 days, transferred to Mr. B for a consideration. But here the problem is capital gains won't get attracted because it is not a capital asset. Capital gain do not get attracted. Okay, but if you read this, television is a movable property. It means not a capital asset, it's a property. Television is a movable property. Therefore, without consideration, if you receive the television, aggregate fair market value, if it exceeds color TV, 4 lakh rupee, Sony Bravia TV is there, 4.5 lakh rupee, purchase, 2 days he gifted to his friend. Okay, so what will happen? Capital gains ki purview lone it will not come because TV is a personal effect for him. Used it for 2 days and given to some other person as a gift. Okay, now tell me, capital gains won't get attracted. Gift will get attracted or not? Gift tax will get attracted or not? Yes. Why it will get attracted? Any property need not be a capital asset other than immovable property. Color TV is a movable property. without consideration. I did not give any consideration to my friend. Fair market value, market rate is 4.5 lakh, which exceeds 50,000 rupees. I exceeded 50,000 rupees. Whole of the aggregate fair market value of such property is taxable under the head IFOS. Yes, it is getting taxed. In this case, how to trigger the provisions? Doubt will come na. So therefore, tell me, property, television, color TV used for my personal purposes will be a personal effect. But here the applicants won't get attracted, but other sources will get attracted or not? Yes, other sources will get attracted because the word uses is property, not a property being a capital asset. Therefore, capital gains, though not attracted, in spite of capital gains not attracted, other sources will get attracted. Like this, you should not think. Yes. Why? Other main point. Here also not getting attracted. Personal effects given as a gift, not taxable, also under 56. Where it was said, that's why you should read Bare Act only always. Explanation D below section 56 subsection 2 class 7. Property means following capital assets. Game over. Capital asset only should be property also here. So synchronization between capital gains chapter and other sources chapter is given here. Property means capital asset. What capital asset? Immovable property being land, building or both. Therefore, in this land, agricultural land will come, will not come, will come. If it is urban agricultural land, rural agricultural land again will not come because rural agricultural land is not a capital asset. See how many linkages are given. Namely, immovable property, shares, securities, jewelry, archaeological drawings, paintings, all these things. Bullion means raw gold, silver, etc. All these things will be treated as a property. These only will be covered. Personal effects will be there. It is not attracting capital gains. It is not even attracting this. Sir, again I got a doubt, sir. You said this is an explanation below 56.27. 27 has no relevance, na? 27 may not have relevance today, but 27 explanation has a relevance. How, sir? Prove me. 56.210 only said that. Explanation below 56.210 said like this. The expressions assessable, fair market value, jewelry, relative, stamp duty value shall have same meanings as given under explanation to class 7. Therefore, property definition, all these will have same meanings as given in class 7. Understood the point clearly? So this is the meaning that you need to understand. With this, we completed interconnected discussion. Now we are going to make in-depth discussion on 56 subsection 2 class 10. See, easier, very, very easy. This chart I will tell you later. This chart I will first explain. See now, whatever is there in the Bare Act, that Bare Act discussion I kept here. Entire Bare Act discussion I kept here. So this much is there in Bare Act. Yes, there. 56.210 is not a small section. Yeah, the rumba big section it is. So let us see. Concept dealt by 56.210. There are three parts. Section 56, subsection 2, class 10, subclass A. Gift of sum of money. Where any person receives during the previous year from any person or persons any sum of money exceeding rupees 50,000 without any consideration, the whole of such a sum of money received from that person or persons by any person will be taxable as a gift under the head IFOS. Previous year of chargeability will be the previous year of receipt. So what is the idea here? Where any person receives from any person or persons during the previous year any sum of money exceeding rupees 50,000 for without a consideration, then the whole of aggregate sum of such money shall be taxable in the hands of that person under the head IFOS. The previous year of chargeability will be the previous year of receipt. So section number 56 subsection number 2 class 10 subclass A says that where any person receives from any person or persons any sum of money exceeding rupees 50,000 without a consideration, the whole of aggregate of such amount of money shall be taxable under the hands under the head IFOS. The previous year of chargeability will be the previous year of the receipt. Done. So if Mr. A receives from Mr. B, not being a relative, not being an occasion of marriage, not on a contemplation of death, not being a trust or any other association, not coming under any of the exemptions provided under explanation below section number 56, subsection number 2, clause number 10, in that case, it is squarely getting attracted by the provisions of IFOS. He will be charged to tax under the head IFOS if it is a sum of money. Next, gift of any immovable property. Gift of any immovable property. Gift of any immovable property will get attracted by section number 56, subsection number 2, clause number and subclause number A, item number A and B. Let us see what are they. Section 56, subsection 2, class 10, subclass B, item A, item B. Okay. See, what is the first part? A. Gift of immovable property. Gift of immovable property. No consideration. What is this? No consideration. Means what? Consideration is not taken. Zero consideration. Okay. Where any person receives during the previous year from any person or persons any immovable property, the stamp duty value of which exceeds rupees 50,000, then the entire stamp duty value will be treated as a gift, taxed under the head IFOS. Which year? Previous year of chargeability will be the previous year of receipt. Okay, so where any person receives from any person or person during the previous year any immovable property without a consideration and the stamp duty value of such property exceeds rupees 50,000, then the aggregate stamp duty value will get taxable in the hands of that particular assessee in the previous year in which the receipt is being made under the head IFOS. It is also easy. Most important one is inadequate part. Section number 56, subsection 2, class 10, subclass B, item B. What it says? Where any person receives from any person or persons during the previous year any immovable property, the consideration is given but less than stamp duty value, the difference should exceed 50,000. See, consideration 1 lakh, stamp duty value 1,60,000, difference 60,000. The entire balance 60,000 is there, na? That will become taxed under the head IFOS. So, where any person receives from a person or persons during the previous year any immovable property, the consideration is less than stamp duty value, then two conditions should get satisfied. Stamp duty value minus consideration means the difference is exceeding 50,000. Not only that, the difference should be more than 10% of consideration. 10% of consideration. Sir, I did not understand. See, I will give you one example. Stamp duty value 1 crore. Consideration. Okay, consideration 80 lakhs. Okay, how much? 80 lakh. Case 1. 92 lakh. Case 2. Okay, 92 lakh. Case 2. Let us understand this way. Case 1. Stamp duty value minus consideration is 20 lakh. More than 50,000. Okay. Next. That difference is there, na? Stamp duty value minus consideration. Difference. It should not exceed. Here if you observe. To attract it should exceed. Not to attract it should not exceed. 10% of consideration. What is the consideration? 80 lakh. 10% of 80 lakhs is how much? 8 lakh. So difference is how much? 20 lakh. More than 8 lakh, less than 8 lakh? More than 8 lakh. So therefore, the entire 20 lakhs will be treated as income from other sources, treated as a gift. Next case. Next case. Let us say 95 lakh. Difference is how much? 5 lakh. More than 50. But what is the consideration? 95 lakh. Into 10%, 9.5 lakh. Difference is only how much? 5 lakh. See, the second condition is not satisfied. No tax will be under the head IFOS. Like that you need to understand. Okay. So, next case. So, inadequate consideration also we completed. What consideration? Inadequate consideration. So, again I repeat. Where any person receives from person or persons during the previous year any immovable property, the consideration is less than its stamp duty value, then the excess amount of stamp duty value over the consideration beyond 50,000, if it exceeds, in that case the entire amount of difference will be chargeable under the head IFOS. Previous year of chargeability will be the previous year of receipt. Okay, next, specified movable property. That's why it should not be television, car, all these are not specified movable property. Those are all personal effects. Specified movable property means explanation we already did: jewelry, drawings, sculptures, shares, securities, bullion, works of art, sculptures, okay, archaeological collections, those. No consideration where any person receives from a person or persons during the previous year any movable property, the FMV exceeds 50,000 without a consideration, then whole amount will be charged, or else FMV minus consideration, if it exceeds 50, that amount only will become taxable. Read now. Nothing great. Now you can read. I want you to read A, B up to here. Next, directly C up to here. Later, I will talk about what are these provisos. Completed. Enough time I have given, around 8 to 10 minutes time for you to fully revise the concept, but listen carefully. Here in the Bayer Act, if you observe, let me show you directly here. Any sum of money if you receive, see, from any person or persons, okay, it need not be one person 50,000, more than 50. One person gave 10,000 gift, another person 20,000, another person gave 30,000. That's it, over, gone. Full amount will become taxable. So because person or persons aggregate value exceeds 50,000. Okay. See, even mobile property, other than immobile property, if you see aggregate, but the word aggregate will be missing in immobile property calculation. Therefore, one immobile property only you should see this 50,000 rupees. Okay. The word aggregate is missing here. That's how observation should be. When you are reading the section, person or person say joint owners are selling a property, joint owners are giving a gift, then person or persons only giving you, but one immobile property only you should see. That's what I have given in the notes below. Under point A and C, means sum of money and mobile property, both, we should consider aggregate value, whereas under point B, it is independent value of one immobile property. Next one, stamp duty value will be taken to be the cost of acquisition. Asal, what is the stamp duty value? On what date you should take agreement date or registration date stamp duty value? That is what given in provisos. What is the subject matter of this proviso? Romba simple here. Listen carefully. I will explain directly in the chart. See, stamp duty value will be there. Okay. If stamp duty value is the same on date of agreement and date of registration, you will take the same. But if it is different, then the problem will come. See, stamp duty value will be taxable under the head IFOSR. Which stamp duty value? Stamp duty value of that immobile property on the date of agreement between people or on the date of registration of property, which should be taken. Generally, stamp duty value on the date of registration will be relevant. Okay, special case. Stamp duty value on the date of agreement will be relevant if two conditions are satisfied. Condition 1, whole or part of consideration is paid on or before the date of agreement. Means before the date of agreement or on the date of agreement, at least some consideration should be paid. And that consideration should be paid by way of account pay check or account pay bank draft or electronic clearance system. If both these conditions are satisfied, then SDV will be taken. Subjected to section 50C. 50C we did not complete. That's why I'm not touching that part of proviso. Okay. Next, proviso. If the above mentioned gifts are received from relative or on occasion of marriage, etc., so many are there, then it will not get attracted. Next. Sir, immovable property ki SDV. But movable property we are not considering SDV, we are computing the FMV. So how FMV will be calculated? See the screen. There is a rule called as a rule 11 UA. It's a rule, not a section. Therefore, Bayer Act you can't find. Rule concept it will be there. Summary of the rule for the exam purposes I have written here. Blindly follow this. First, if it is a specified movable property, if it is a specified movable property, shares, securities, etc. Are these there? Then movable properties are of two types. Movable property being shares and securities, movable property other than shares and security like jewelry, archaeological collections, sculptures, works of art, bullion, drawings, paintings, all these will be there. Na? Those all other than shares and securities. Then FMV will be price which these could fetch if sold in the open market on the valuation date. On the valuation date means what? Valuation date is what date? Either date of gift or date of agreement of specified movable property. So date of acquisition of specified movable property. Date of acquisition of specified movable property. That date you need to take. Normally in the market, whatever the price it is fetching. For example, there is a painting. There is a painting. Go there. Ask about the paint value. That painting is in a drawings or paintings. Ask about the value. they will tell one value. That will be the fair market value. Fair enough. But when it comes to shares and securities of a company, again they are divided into two categories: quoted shares and securities, non-quoted shares and securities. What do you mean by quoted? Listed on a recognized stock exchange. Non-quoted means not listed on a recognized stock exchange. If shares and securities which are gifted are quoted shares and securities, then two situations again. How you acquired them? Acquired through recognized stock exchange or acquired other than through recognized stock exchange? Okay. Why, sir, other than recognized stock exchange? If purchase is made through public offer directly, from company I will take, not from the stock exchange. And second, promoters' shares will be taken directly from the company, not through stock exchange. Normally, you and me will buy through RSC. So if you buy through stock exchange, then the transaction value will become the FMV. What will become FMV? The transaction. At what price you purchased it, the transaction value will become your FMV. Quoted. If quoted shares are acquired other than through RSE, then are they traded on the valuation date? Yes, sir. Then take the FMV. What FMV? Lowest price quoted on the valuation date. Valuation date, there are 10 prices. In that, what is the lowest one? That lowest price you need to consider. Not traded on valuation date. Lowest price quoted on closest date immediately preceding the valuation date. On the valuation date, it is not traded. Okay, that share is not traded. Latest traded day is there. On that day, what is the lowest price that you need to consider as an FMV? So start. Shares and securities. Quoted. Acquired through RSC. Transaction value will be considered to be RSC. Okay, transaction value will be considered to be FMV. Next, shares and securities. Quoted. Acquired other than through RSC. Are they traded on valuation date? Yes. Lowest price quoted on the RSC should be considered on that valuation date. So lowest price is not available, sir, on the day. Trade not happened on valuation date. Okay. In that case, latest will be there before that. That day lowest price will be taken as FMV. Sir, mine is a non-quoted, sir. Mine is an unlisted company. Unlisted public company. Those shares he gave me. Then other than equity shares, price decided by merchant banker you need to consider. Merchant banker or even FCA. So fellow chartered accountant, merchant banker or FCA has to determine the price of other than equity shares, preference share, debentures, etc. If it is equity share, next page I have written. See, X, Y. Y gifted to X non-quoted equity shares of ABC Limited. Gifted. So FMV to be calculated as per this rule. See here. First, consider the balance sheet of ABC Limited. Okay. See, listen carefully. These shares are getting valued now. Okay. These shares are transferred. See here. So, see here. How to calculate the FMV of non-quoted shares? We are into that point. See, first, as I already discussed, Y gifted non-quoted equity shares of ABC Limited to Mr. X. Now, I wanted to know the fair market value of these equity shares of ABC Limited. Fair market value should be calculated as per this rule. What this rule says? This rule says which company shares you are giving as a gift? ABC Limited. Take its balance sheet. Take its balance sheet. On the balance sheet, take 4 different assets. Number 1, specified movable assets. Specified movable assets. Jewelry, sculptures, works of art, drawings, paintings, archaeological collections, bullion. Take all those value. For all of them, there will be a running market value or not on the valuation date. Take that FMV. Note. See here. These all are the things. Next, shares and securities. Sir, shares and securities we are valuing now. Listen, we are valuing the shares and securities of ABC Limited. And this value we are calculating. Are you understanding or not? We are valuing this value. This is another company. I invested. For them also using the same rule, you have to calculate the FMV. So calculate FMV. Shares and securities on asset side invested by company also are to be calculated as per the rule. That company balance sheet you need to take. Same like this, you need to calculate FMV of those shares. So shares and securities, you have to take the FMV. Immovable properties, take the SDV. Any other assets other than specified movable assets, agricultural land is there. It is not a specified movable asset. It is not a immovable property being a capital asset. Then that will come under the book value. So all those things you take. So these are 4 things you need to take. This is A. As per the rule I am telling. This is A. Other assets is A. Specified movable property B. Shares and securities C. Other immovable properties will be D. A plus B plus C plus D. Total assets minus outside liability will give you net assets value. So FMV is what? A plus B plus C plus D minus L. Okay, L means outside liability. That will give rise to net assets value. That will give rise to what? Net assets value. So the summary amount will be the net assets value into PV by PE. Sir, what is PV by PE? PV means the paid up value of your gifted shares. Paid up value of your gifted shares. Next, what is this PV? What is this PE? Paid up equity value of the total shares. Means I did not gift everything. Na? Let us say, for example, 1,000 non-quoted shares he has given as a gift. That 1,000 shares ki paid up value will come under the calculation of PV. Total equity capital of a company will come under PE. Simply to understand, this is percentage of gifted shares value to the total equity shares paid up value. Understood? If this is the total net assets of total company for PE value, for PV how much it is? So this into this divided by this. Okay, that's why in FM so many times in FM classes I used to tell, shares do not have any value on their own. Shares will derive value from the assets. Okay, so here what is this total net assets? If this net assets is attributable to total PE, what is the value attributable to my gifted part? Is the PV. That's called as the fair market value of the shares. Okay, so this is how we need to calculate. With this, we have completed fully the concept of section number 47, clause 3, read with the section number 49, subsection 1, read with section number 49, subsection 4, read with the section 2, clause 42A, explanation 1, sub-explanation 1, clause B, along with the section 56, subsection 2, clause 10, subclause A, B, C, and in subclass B, item A, B, subclass C, item A, B, we completed everything. Okay, income from other sources, the crux part is completed now, along with capital gains chapter. Okay, when I come to other sources separately, next after this, there are around 12 to 13 transfers, small areas are there. I will complete in one lecture. Finally, we will be coming into buyback, reduction of share capital, liquidation of company. Okay, these 3 we are going to complete. Super areas, extremely interesting areas we are going to discuss along with other sources. Deemed dividend linkage. Which one? Deemed dividend linkage also we are going to do. Okay, so with this we completed section number 47, class 3. Next class, 12 to 13 different transfers we are going to cover and complete. Okay, thank you. Next lecture we will be meeting soon again with a different concept. Okay.